Welcome back to A Bite from the Money Sandwich, where we provide practical and easy to understand tips and ideas on how to manage your money better, so as to let you retire with comfort and on your own terms. We all want our money to work harder for us, but what if we can also help create a more sustainable future? Today I am joined by Marshall Brentnall, Director and Senior Financial Planner at Evalesco Financial Services, as well as a member of the Investment Committee of AAN Asset Management. Marshall is also an award-winning advisor, winning the IFA Investment Advisor of the Year in 2021. Marshall and I will discuss how ethical investing is becoming more and more popular for investors and clients, and how the increasing demand is shaping the way superannuation and investment funds are looking at their portfolios. Well, welcome, Marshall, to the podcast.
Thank you for having me, Mark. It's a pleasure to be here.
Well, the first question I'd like to ask is, well, you're an advisor and a partner with Evalesco, so what brought you towards being an advisor, or why you chose this type of career?
I guess the background, Mark, is if I go back a few decades, was that I was in a business supporting financial advisors, and I guess I was living and breathing all day, every day, what it is that they do. And I thought I'd love to become one.
Okay. And now you've been doing this, as you said, for a couple of decades. Probably what's the most rewarding part of it for you?
I think, when people come to see us, they assume that it's all about the money and the portfolios that we might manage for them. And without a doubt, we seek to deliver some great outcomes in that area. But often it's the incidental conversations that you have that lead to really amazing outcomes, helping people, acquire their dream home or support their children, or just, removing anxiety from their table where you can.
Yes, no, I couldn't agree more with that. And this has now led you, because I've known you for a while, but I didn't actually quite realize you had a real interest in the ethical investment or side of it. Can you quickly explain what that is? And I know a lot of people say ESG investing, which the common misconception is the E stands for ethical, but it's I'll let you explain what it's all about.
No problem. It's certainly garnering or capturing more and more headlines these days, Mark. And I guess ESG is just another acronym that we like to talk about in financial advice or financial services. But what that means is environmental, social, and governance factors, and how some of those protocols can be used to build portfolios.
And I know, just speaking to someone only a couple of weeks ago, in the governance side of it, it's amazing that with so much investment in corporations, they can actually look at the governance of an actual organization, and if they're not doing the right thing, make sure they do the right thing.
Yeah, they can. And certainly, whilst we all might have different points of view in terms of, our impact on the environment and the way in which we interact with each other, certainly. More and more, it's some of the conversations that are happening in the boardroom that are trying to drive positive outcomes within some of these major businesses.
And I was just even seeing something like Oz Harvest and food wastage and all this, and there's a person, a CEO, who just says, well, yes, I'm a business person, but if I can help change the planet, why wouldn't I?
Why wouldn't you? I agree, Mark.
So just tell me why you took an interest in the ethical investment side of it.
I think, so within our business, I sit on we've got a team of about 20 advisors and support staff. And within our business, I'm the investment committee representative within our team. So a lot of questions will come my way. And really, it's about making sure that we're able to give our clients choices around where their money is allocated.
And so take that a bit further. People want to do the right thing, and people want to do the right thing for the planet. How is the investment market working in that way?
In very different ways, actually, and it is quite a confusing landscape. One of the responsibilities I take pretty seriously is, over many decades, and I suspect that you might have experienced this in the past, Mark, there's a whole plethora of investment options available for financial advisors to recommend to their clients, and indeed for investors to access directly. And sometimes product manufacturers get a little bit ahead of the curve and they bring out products that might not always be in the best interest of clients, and they might also be promoted as something that they're not really. And it's my job to make sure that, I guess, less mistakes are made, and that when we allocate clients' monies, we really understand what's under the hood. We're really comfortable with the investment philosophy, and it's going to deliver consistent outcomes for our clients.
And we'll speak more actual what some of the ethical investments are, but one of the historically, and ethical investment has been around for 20 odd years, but they were very expensive, and it was very hard to sort of say, well, this company wasn't a company that promoted tobacco, for example, and it might be gambling today, but they've become a lot more sophisticated. They're not as expensive as they used to be, and their returns are actually stacking up.
Yeah, so I would certainly say that historical point of view that you had to pay more to have your portfolio ethically managed. That's certainly not the case these days, and you don't always have to give up performance for that to occur. What I would say, though, is that there's a very significant demand for these types of products, and as you would know, when demand is high, often prices are high as well.
Sure.
So there is certainly some manufacturers out there that I think are possibly charging a little bit too much money for the privilege of managing portfolios ethically. Whether there's a misalignment there, I'm not quite sure, but I think that's really just the demand and supply mix coming into play.
And so historically, if it was quite simple to sort of say, okay, I didn't want to, if I was an investor and I was looking at companies that Winfield's, the old tobacco company, and so I didn't want to have a company that invested in that company, or it might be a gambling company, or use cheap labor from overseas. It's now, as you said, it was environmental, social, and governance. How is that, from you saying before about you need to look under the hood, how can you do that and get a sort of a grip on all the changes that are happening?
Yeah, so there's a couple of different levers that we can pull, Mark. Modern administrators or superannuation funds will provide more transparency to advisors and investors. And what that means is that if you have a personal view that you'd like to avoid armaments manufacturers, alcohol producers, gaming businesses, we can often exclude that stock or that type of industry from your portfolio. That's kind of like the first lever. And that was the initial discussions that we were having with many of our clients around their personal investment choices. But as I guess as time moves on and capabilities increase, we realized that some clients wanted to exclude more than one or two industries. They wanted a more robust or broader framework around what types of industries are completely excluded, but they also didn't want to end up with only half of a portfolio, if that makes sense.
Yeah, okay. And with that, and you can see, as you said, that people are wanting to do more, people wanting to take more of an interest. They basically want to help save the planet if they can. And using your superannuation funds, it's a $3 trillion industry, there's a lot of help you can do. So is that probably the first point of call, to look at your superannuation fund to see if those type of investments are that are on offer?
Yeah, I think when you talk about the ESG components, the one thing I would say to provide many of your listeners with some peace of mind is I think that most major superannuation funds in Australia will already be ticking the boxes for the S and the G.
Right.
From a governance viewpoint and a societal viewpoint, they're running their businesses in a responsible manner. They're investing in businesses that do the same. you're avoiding child labour and human rights abuses. It's I guess, how important is some of the E to you? Now, over time, I think some of the major pension funds and superannuation funds are going to make that E very big within their portfolios. And some of them, even without perhaps your individual awareness, are already starting to remove high-impact fossil fuels and other types of investments from their portfolios. So certainly the peace of mind is that most of the major superannuation funds in Australia are doing the right thing with the S&G. It then comes down to what are the investment choices or investment considerations that are important to you, and to then consider, well, how do you allocate money according to that?
Okay, and taking that one step further, it is important to that person, for example,
Yes.
but then also you must have to take into account their risk profile, because these are all share-based companies, so they can go up and down with the market.
Correct. So what I would say is that when clients come to our firm, if I talk about ethical investing, there are different names for it. There's ESG, ethical investing, sustainable investing.
Right.
And then perhaps down the further end of the spectrum, there's this concept of impact investing. Now, the first couple of categories that I talked about are really just about avoiding some businesses that you don't want to invest in.
Right.
Impact investing is, next level, where you're allocating capital, sometimes to more, blue sky or unproven technologies, with a view that you might deliver better outcomes. Most advisors that I've worked with historically, and certainly most of the investors that we work with within our business, are really more focused on excluding sort of up to 5 or 6 of the typical areas that you want to avoid, such as armaments, high-impact fossil fuels, predatory lending, and a range of other things. So they're wanting to avoid that whilst investing in sensible businesses. They understand what's there, avoiding leverage, that type of thing.
Yeah. Okay, and if you're saying about avoiding leverage or the borrowings or debt levels that are there for some of these corporations, so how would you compare them as a risky type investment compared to, say, the 4 big banks, the big blue chip type companies that we all know of?
I would say that over time, I certainly am of the view that with the demand that is in place within certain segments of the community, the debate that's being driven in the boardrooms, there will be a substantial weight of money and flow towards this sector.
Right.
And as a result, I think that over the medium to long term, you'll see some quite positive outcomes from ethical portfolios. But once again, there are certain periods in time where challenges will exist. So, for example, over the last quarter, with some of the political and economic events that we've seen both in the Ukraine, but also what we're seeing with energy prices, some ethical portfolios have really been held back from a rate of return viewpoint because they don't have an exposure to oil and gas and other energy sources.
That's right. And when just something I've only heard just the other day, that how it does actually impact people in Italy, because they get 2/3 of their gas supply from Russia. They're not during this summer allowed to put the air conditioners on until the temperature hits 27 degrees. So you actually see the effect of it. So that's actually every day. Yes, you want to save the planet, but you also need to sort of take into account these other factors. So I would imagine, therefore, you would still look at, if you're ever considering these type of investments, it would have to be a mid to long term time frame as well.
Yes, it would. So many of the portfolios. So there are different ways that investors can make choices in a strategy like this. So if you think about most of the the superannuation funds that your listeners would be able to invest in. Typically, the ethical portfolio that would be presented to them would be what they call a balanced or a growth fund, and that would have anywhere from 70% in shares and property to perhaps up to 90%. So with that in mind, you would expect that they'd be wanting to invest for, at least a 5 to 7 year window. And realistically, even if you are approaching retirement, it's important to consider that if someone is going to be retiring at the age of 60 or 65, or perhaps they're fortunate enough to retire at 55, they've got an investment time frame of 20, 30 or even 40 years. So it is really important that you allocate some capital to the likes of shares and property to give you access to that growing income stream.
Yeah, I think that's a really good point, because it's something I often say to our pre-retire clients or the clients I'm coaching. It's just because you're now retired doesn't mean you're now putting everything into cash. You're hopefully going to live for another 30, 40 years. You want your money working hard for you so you can enjoy life. Was actually someone said that, the greatest risk isn't actually where you invested money, but that you could outlive your money. So it's important to still make it sure it's working harder for you. So if we're looking at a typical portfolio, if someone, because as you were saying, if a fund was doing a balanced or growth and they're doing that for you, but if you were just basically picking funds yourself, would you say 10%? And we know this is not advice. I'm just sort of saying this is something, say, typical of some of your clients or what people have been doing. It seems to be around 10, 20% of the portfolio. You probably wouldn't do any more because it's still a new investment type.
So there are different ways to look at that. So certainly, I think younger clients that are in the accumulation stage,
Right.
perhaps they're 20 or 30 or even 35. If you're investing in a portfolio that, once again, ticks all the boxes in terms of you're investing in businesses that are proven with regular, reliable cash flows, not unproven technologies, there's no reason why you couldn't allocate a greater percentage of your portfolio. So we have a number of accumulators that are in our sustainable model. They'll allocate 100% to that portfolio. Retirees that based on those investors that have come to us. So if someone is very passionate about ethical investing, they might not actually go directly to an advice firm like ourselves. They might go directly to some of the major superannuation funds or even advice firms that have built their business on ethical investing.
Yes.
So the retirees that I work with, I've got a number of them that have allocated capital to sustainable strategies, and often it will sit either side of that 20% category. And if they've got a particular industry that they want to avoid, they can still do that for the broader portfolio.
And you were mentioning before about your own sustainable portfolio that you've built for your license, or you've helped build for your license, and all the advisors and clients under that. How do you do something like that? Do you actually look at, say, well, we're going to diversify, so we're going to look at, say, 5 or 6 different ethical or ESG type funds. They're going to specialize in different areas or different levels of risk. How do you build a portfolio? How did you start when you looked at your own portfolio?
Yeah, we did that, Mark, after having already built 5 broader portfolios. So essentially our firm is made up of 4 individual businesses across the Eastern Seaboard, and we manage, I guess, the retirement savings for either side of about 4,000 families. Now, instead of each firm building their own portfolios, coming up with their own investment philosophy, we've created one together, which I think has led to more questioning, more rigor, and certainly more consistency in outcomes for our clients as a result of the questions that we ask ourselves each and every month with independent researchers on our investment committee. And in building those portfolios, we then realised that there is certainly a market and a demand for a standalone sustainable portfolio, and we wanted to use the same framework as we did for the others. So we weren't seeking to create something new. we wanted to make sure that we once again had that equal balance between Australian and international shares, so we weren't there was no bias over one over the other, and we wanted to make sure that we had the same series of investment styles within the portfolio. So as an example, within Australian shares, we wouldn't just pick one Australian share manager. We would typically pick one that was focused on the broad index, which is what you would see on the nightly news when Alan Kohler or another TV host will talk about what the Australian share market has done today. And then we would have several other investment managers that do slightly different things. And it was actually a very complex process. Building a sustainable portfolio was more complex than building our broad-based mainstream portfolios, because the trustees essentially said, look, it is actually very unusual for an advice firm to build a sustainable model, because you need to be able to guarantee that these 6 things you wish to exclude, the investment managers you're choosing will maintain that ethos. So we had to, it took us between probably 14 months to build it. Lots of negotiations with the different investment managers to ensure we had the transparency in the data flows, to make sure that both the trustees were comfortable and we could deliver what we said we would.
Yeah, no, it's interesting. And, some people might say, oh, we're giving you a plug for this, but I have had people who definitely say, well, how does an advisor, how do they build these models? How do they actually adding value when they're doing this sort of thing? So it's actually good to get a bit of an insight to that. So thank you for that. So Marsh, where do you see actually the future of investing is, say, 5-10 years from now? Like just in the last 5 years, it's just grown enormously. And I'd be just curious to know where you see this may head.
Yeah, Mike, there's certainly been a tremendous amount of change over the last 5 years. And I guess at a client and investor level, what I'm hoping for is more choice. At the moment, there's a sort of a handful of major players in this area. So I'd like to see a little bit more competition, which should mean that we can deliver some sharper pricing at the client level. Certainly, as a business, we'll continue to focus on that ethos of, allocating to the cash and defensive strategies that are pretty simple and straightforward, and really not wanting to get swept up in the furor or the excitement of the brand new technologies that are coming out. So we'll very much sort of focus on some of those boring allocations. But what I would like to see is more transparency of data within superannuation funds, so that investors have a better understanding of where their capital is allocated and the ability to make some choices should they wish to tinker or tweak what is there, and certainly greater supply so that we can provide investors with more choice and lower fees.
Yeah, I think the broader choice would be great, because yes, there is a lot more choice now than was even 5 years ago, but yes, it'd be great if there was even more choice. One of the things I actually personally looking forward to is, I think, definitely you were saying before about the social and the governance side of it. The more and more money that's coming into superannuation and allowing investment funds, investment firms to invest their money in corporations, they will definitely be able to make sure that how these companies on their social and governance side are actually are helping people, and that's definitely, to me, it's only going to be a good thing. So I am really looking forward to seeing how the next 5 and 10 years go. One of the things I actually like, I've got you're an advisor, you're an experienced advisor, you're an award-winning advisor, Marsh, so congratulations on your award recently.
Thank you, Mark.
One of the things I definitely like is people do consider, and we're just talking about people looking at their own superannuation funds, choosing the funds, but you always have that choice. You can actually go to an advisor, get their help. In a nutshell, why would someone actually go see an advisor like yourself or any advisor that's out there?
I think I don't think I know that when an investor goes to see an advisor, and if it's the right advisor that aligns with what's important to that client, it's more likely they'll make certainly less mistakes. They'll take action, which is a really important part of the framework. And ultimately, it should lead to peace of mind, less money worries for the investor.
Yeah, no, well said. One thing I would like to add to that, though, is, and you do this, but you don't, without realizing, is how well you keep your clients accountable. It's just like the whole New Year's Eve resolutions type of thing. How long they average is usually about 2 to 3 months. But if you've got someone like you, if the best tennis player in the world still feels he needs a coach, why wouldn't you do it for your own finances and financial future? So I think that's one of the things advisors do really well as what you were saying. Now, I've kept you long enough, but one of the final questions we do like to ask all our guests is, what's the best piece of advice you've ever heard? Whether that's family, financial, whatever.
Where do I start?
Oh, okay. You can do more than one if it's hard to decide.
I guess I'd have a couple. One certainly would be, the importance of owning your own home, because I think that enforces discipline, and it allows you to then go to the next level. And so I've said, owning your own home, spending less than you earn, and allocating the balance to good quality assets. But an extension of that around your own home, and this is something my dad taught me years ago, or he's told me years ago, was that when it comes to purchasing a property, time heals all wounds. Now, if you're looking to buy a family home and your budget is X and you end up spending just a little bit more than X, over a 20-year period, that small margin extra that you ultimately paid isn't really going to make a big impact. So if you can afford to spend a little bit more, it's okay to do so. Because typically time heals all wounds.
That's a good point. My grandmother in Des Moines, and they really wanted this home, and it was $30,000, and they needed to go to $31,000, and they just couldn't do it. But looking back now, that extra $1,000 would have made a big difference.
Yeah, I mean, absolutely. If you'd have bought a home for, let's say, the average home was selling for $80,000 in Sydney, and you paid $85,000 in 1980. Yeah. Well, your parents said all of their peers and friends probably would have said you're crazy. But 30 plus years later, that extra $5,000, while significant at the time, is quite insignificant now.
Absolutely. Yeah. No, really good points there. And owning your own home, you've got to live somewhere, and why pay rent if you don't have to? So no, a really good point. Well, Marsh, thanks very much for your help and being on our podcast today. And maybe we can talk again soon on ethical investments or some other subject soon.
Would love to. Thank you for having me, Mark.
Thanks, Marsh. I hope you enjoyed this episode. If you'd like to know more about Marshall Brentnall and the Sustainable Growth Model, visit aanam.com.au/investment-models or contact Marshall at evalesco.com.au. Feel free to also email me on admin@themoneysandwich.com or visit our website, themoneysandwich.com, if you have any questions or would like to learn more. Enjoyed this episode and want to hear more of A Bite from the Money Sandwich? Make sure you subscribe on your platform of choice so you can automatically receive each episode as soon as it's released. As with every podcast, this information is not advice, as not personalized to your own situation. And past performance is never guaranteed for the future. What we are trying to do here is to provide tips, coaching, and education to help improve your money knowledge, which we believe can only be a good thing. See you next time when we take another bite from the Money Sandwich.